Ready to elevate your credit understanding and score? With insider tips and a plan, you can take action to improving your score, which can save thousands in unnecessary finance charges. Let's tackle today's topic with your coach, Credit Christy.
Hey friends, it's Christy, your credit coach. Thank you so much for joining me for another episode. Today, let's talk about payment calculations on a credit card. So credit cards have a very different setup from any kind of installment loan. So an installment loan is going to be like your car payment, student loan, mortgage, something along those lines where it's a set payment for a set period of time until it's paid off. A credit card, being a revolving trade line by nature, can change what the required minimum payment is every single month. I'm sure you've heard me in previous episodes and you see on the headlines all the time that the interest rates are going up. The Fed funds rate has gone up 5 times this year and is continuing to go up. The Fed is set to meet another 2 times this year and will very likely raise those rates again. How does this affect you? The Fed funds rate is really what sets the prime index rate. And the prime index rate is what your APR on your variable credit card is attached to. So most credit cards are variable. This means that when that prime index rate changes, so does your APR. There are a few other variables that might change your interest rate, but let's first talk about how your minimum payment is calculated. So typically, if you have a smaller balance at the time that your payment is due, you might find that your credit card has just a minimum payment of $25 or $35 a month. But if you carry a balance larger than $1,000 or so, you might find that your minimum monthly payment is one of these 2 calculations. The first one is just a hard and fast 2% of your outstanding balance. In this calculation, if your APR exceeds 24%, they can't use this calculation because your minimum payment no longer pays just the interest portion. In other words, if it's greater than 24% APR and they use this 2% calculation, then not only are you not paying all of the interest calculated, but you're also not paying a dime in pay down of that principal balance. So when you have larger than $1,000 balance, and especially if your APR is 24% or higher, then the calculation goes like this. It's 1% of your outstanding balance plus any accrued interest for that month. And if you're curious how your credit card does it, you should be able to find it when you log in under your account details. So here's how this might look. Let's say you have an outstanding balance of $3,500. and your APR is 24%. We take that $3,500, multiply it by 24%, and this gives you your annual percentage, which is, in this case, $840. So you're going to divide that by 12 because, again, we want to find out our monthly interest liability, which is now $70. And we're going to add that to that 1% of the outstanding balance. So if we have a $3,500 balance, 1% is $35. So we add that $70 plus the $35, and your monthly payment calculation is $105. I know it sounds really confusing. If you tried it once or twice on your calculator on your phone, you'll see it's not quite complicated. But what I think will get muddy is APRs are changing. The majority of credit cards out there are on a variable interest rate. And if the Fed is meeting again 2 more times through 2022, and it's likely that they'll raise that interest rate again, then this minimum payment of yours will be changing in the near future as well. I especially wanted to share this information because I know how important it is to balance and budget your money every single month, especially when things are getting even more expensive every single day just to live. So if you carry a balance on your credit card, really pay attention to your patterns and your behaviors when it comes to the use and the payments of your credit cards. The reason I'm pointing this out is because if that minimum payment is going to continue to increase, if the cost to borrow that money, that interest rate is going to continue to increase, your number one goal right now is to get out from underneath that credit card debt. There are 2 types of credit card users. There are transactors. They just use the credit cards for the points and the rewards and just for the simplicity of being able to put all of their bills at one place on one time and make one monthly payment. And if you pay that balance off in full prior to your due date during that grace period, you will not accumulate any interest charges. It should be a 0% APR. But if you are a revolver, and a lot of people are heavy revolvers, which means that you carry a balance forward every single month and you're constantly using those credit cards and carrying or maintaining a balance, then this message is for you. Pay attention to how you use your credit cards. Unfortunately, I'm seeing a lot of behaviors and patterns recently where some of my clients have anywhere from 15 to 25 credit cards with balances on it every single month. And especially if it's a store credit card, you're probably paying somewhere in the mid to high 20s on an APR. So if your habits or your routines have been that you just use your credit cards, you don't put much thought into it, you always make your monthly payment, at least that minimum payment, start with a new goal of getting the lowest balance credit card gone. Just wipe it out, pay it off. If you have to sell something, if you have to take on some extra hours at work, just really commit to having that balance, get to zero and remain at zero. Don't close up that credit card, just leave it open because you want that debt utilization to help you. And then once you have those tiny ones paid off, then go and look at the highest interest rate on your larger balances of your credit cards and tackle that one first. If you have a decent credit rating, you might want to apply for a 0% introductory offer to transfer over that balance. If you can avoid 24% APR and have 100% of your payment going towards reducing that balance, that's the way to do it. Unfortunately, the people that I see that are buried in credit card debt also get slapped with a very low credit score because they're overutilizing that credit that's available to them. So if that's the case, you've got a lower credit score, you may not qualify for one of those 0% introductory offers. Now, I had alluded earlier why APRs might change. So in addition to the prime index rate going up, if you incur a late fee, so you've made your payment late, you can also incur a penalty APR, which means your interest rate goes up for a designated amount of time. Now, if that's the case, the creditor has to review your account in 6 months. So put it on your calendar if that's the case to make sure you call them and make sure that they are reviewing your account to potentially reduce your interest rate back down again. If you have exceeded your maximum credit limit, you might also incur an extra high APR. So make sure that you do not max out your credit cards because you could be punished by having a higher interest rate that way as well. Keep in mind that your payment history makes up 35% of your overall credit score, and that's something you can absolutely be in charge of. So make sure your credit card payments are on time, every single month, and protect yourself that way. We don't need any unnecessary charges at this point in our lives, right? Hey, thank you so much for listening. And if we haven't already connected, reach out to me on social media at Credit Christy. I'd love to connect with you there. And until next time, my friends, stay well.